Welcome to Talk Tickers. We're doing our deep dive into the earnings calls that, well, really define market narratives. Today, we are absolutely laser focused on Lumen Technologies. They reported Q3 2025 results just after the bell on October 30th.
Yeah, and this deep dive feels necessary. Lumen's story is probably one of the most complex in telecom right now. We're not just, rattling off numbers. Our mission here is to cut through all that noise. We want to assess the execution behind this massive strategic pivot they're attempting.
Right, the transformation into what they're calling the backbone of the AI economy.
Exactly. It's a big claim.
Okay, so let's try and unpack this story. It's kind of a mix, right? Legacy decline versus future promise. Despite those headwinds from the older business lines, they did manage an upside surprise, financially speaking. Revenue hit $3.087 billion.
Yeah.
Importantly, that beat the consensus by about $50 million.
Yeah, it did. And look, that's still down 4.2% year over year. You have to mention that.
True.
But beating expectations, that was the positive takeaway on the top line.
Yeah. And the leverage showed up on the bottom line, too.
It really did. The non-GAAP diluted loss per share was negative 20 cents.
Which was quite a bit better than the negative 26 cents the street was braced for.
6 cents better, yeah. And adjusted EBITDA landed at $787 million.
Which gives them a margin of what, 25.5%?
Yeah, 25.5%. Pretty healthy, honestly, given everything going on in their operating environment.
What really caught my eye, though, was the cash generation. Especially because, any transformation this big just eats up cash. Liquidity is key.
For sure. Operating cash flow was strong.
And that free cash flow number, excluding the special items, was really impressive. $1.661 billion.
Yeah, that's the fuel. That's what powers this AI engine they're trying to build, like you said.
And the market reaction, it kind of perfectly mirrored the whole story, didn't it?
It absolutely did. You saw that sharp sell-off right into the close.
People pricing in the risk, the legacy drag.
Exactly. But then, whoosh, a really rapid, almost violent rebound after hours.
Once the details about the strategy came out.
Right. The stock climbed, about 7% from the close. It just shows how tightly traders are clinging to this AI pivot narrative.
So the financial beat was, let's say, modest.
Yeah.
The real headline here was the strategic progress. Management basically framed the entire call around Lumen building the essential architecture for Cloud 2.0.
And that means focusing squarely on two things: their private connectivity fabric PCF and the network as a service platform, NaaS.
And the PCF update was pretty eye-opening.
It really was. They announced signing another $1 billion in new PCF deals just in October alone.
Wow, okay.
Which immediately pushed the total awarded value for these PCF deals over the $10 billion mark.
So let's pause there. What does that $10 billion really mean for you listening?
It's not just a big number.
No. It's proof, isn't it? Proof that Lumen has these unique physical assets. We're talking deep, dark fiber roads.
Stuff that's hard to replicate.
Exactly. And the hyperscalers, the neo-cloud providers, they desperately need this stuff for the next wave of AI, training, deployment, all of it.
They need those private, super high-capacity highways. Competitors just can't spin those up overnight.
So it confirms that their physical network, the right-of-way, it's becoming, kind of indispensable in this AI arms race.
Totally. But the transformation isn't just about these massive bespoke PCF projects.
Yeah.
That digital layer, NaaS, that needs to gain commercial traction too.
And we saw some early evidence there, didn't we? The digital adoption metrics look pretty strong.
Incredibly strong, yeah. Active customers using the digital platform jumped 32% just quarter over quarter.
32%. And services sold.
Services sold through that platform grew 36% in the same period.
So that tells you the shift towards agile software-defined networking is actually starting to resonate.
Yeah, with the broader enterprise base, not just the hyperscalers buying the giant pipes.
That NaaS platform, it fundamentally changes things for enterprise customers, doesn't it?
It really does. Instead of these fixed multi-year capacity deals.
Like the old days.
Right. Now they're buying connectivity more like a utility. On demand, pay-per-use, super flexible.
And that lets Lumen move up the value chain, offer more software-based services.
Precisely. They're also expanding the ecosystem around it. They talked about that multi-year Palantir partnership.
Right, aimed at faster, secure AI deployments.
Yeah.
Integrating Palantir's platform right into Lumen's network fabric.
But the really exciting bit, commercially speaking, was the launch of Internet on-Demand IoD OffNet.
Okay, OffNet sounds technical. Why is that such a big deal?
Well, the financial impact could be enormous. It basically means Lumen can now sell its digital services, its software platform, even if they don't own the physical last mile connection to the customer.
Ah, so they're partnering up with other local carriers to reach those end customers.
Exactly. And by doing that, they just unlocked a huge market that was previously off limits.
How huge?
Management said this single move expands their addressable market by nearly 100 times, just in the US.
Wow. 100 times. So they're basically monetizing the digital layer, the software, regardless of who owns the physical wires underneath.
Yeah, they're separating the physical asset value from the software distribution value, which is clever.
And that separation, that leads directly to this new metric they introduced, right? The PXQ model.
Right. Ports times quantity of services times price.
So moving away from just measuring bulk capacity sold.
Exactly. They're signaling a shift towards measuring the utilization and the value of services delivered digitally.
They're trying to evolve from being seen as a CapEx-heavy utility
To more of a digital OpEx-light service provider. And if they pull that off,
it justifies a totally different valuation multiple down the road.
that's the hope.
Okay, huge structural change. But let's be blunt here.
Yeah.
None of this AI pivot, none of this digital transformation really matters if the balance sheet is still this suffocating headwind.
Yeah, the debt load has historically been a massive issue, scared off a lot of generalist investors.
So what did the call tell us about that?
It confirmed they're being really aggressive on the, let's call it, financial hygiene. They managed to complete $2.4 billion in debt refinancing and repricing just in Q3 alone.
That's a big chunk. What does that mean for interest costs?
Well, just those Q3 actions shaved off about $135 million in annual interest expense.
Okay, meaningful.
And year to date, the total interest savings are now up to $235 million.
That's good progress, but the real game changer here is the asset sale, isn't it?
Oh, absolutely. The sale of the consumer fiber business to AT&T, $5.75 billion.
Still on track?
They reiterated it's on track for an early 2026 close, and management was crystal clear about the proceeds.
Paying down debt.
Yep. Reducing super priority debt by approximately $4.8 billion.
And that's a number investors are watching, right? Because that hits the leverage ratio.
That is the single most important metric. That debt paydown, it's expected to bring their overall leverage ratio down below 4 times adjusted EBITDA post-close.
The sub 4x, that's a key threshold.
It is. And the total annual interest savings from all these actions, including the AT&T deal impact, are expected to hit a staggering $535 million.
$500 million, just straight back to the bottom line, essentially.
Which is why management felt confident enough to declare that debt is, quote, no longer a headwind. They see it rapidly becoming a competitive advantage, actually.
Okay, that sounds incredibly bullish. Fixed balance sheet, unique AI infrastructure. So why is the market still pricing in so much risk? Is the core growth actually taking hold?
Well, we can see some evidence that the pivot is taking hold even outside those huge PCF contracts. You have to look at the business mix shift.
Okay.
Their designated grow products, think dark fiber, IP, the NaaS stuff. That bucket now makes up 50% of North American enterprise revenue.
50%. That's up from what?
Up significantly from just 35.5% 3 years ago.
So hitting 50%, that feels like a critical milestone psychologically and financially.
It really is. And that gross segment revenue, it increased 10.5% year over year.
Double-digit growth in the core network products they want to grow.
Exactly. That's key evidence the pivot's gaining traction in the broader enterprise base, and it's starting to successfully offset the decline in the legacy stuff.
All right, so let's talk outlook. What did they guide for the rest of the year?
They reiterated the full year 2025 guidance, but interestingly, they signaled a pretty clear bullish bias.
How so?
They're steering investors towards the high end of that $3.2 to $3.4 billion adjusted EBITDA range.
Okay, so expecting a strong Q4 finish, that's a vote of confidence.
It is. And on the spending side, CapEx, they guided towards the low end of the $4.1 to $4.3 billion range.
Citing efficiency.
Yeah, increased efficiency and better timing on deployments. Free cash flow for 25 was also reaffirmed, $1.2 to $1.4 billion.
And that includes a tax refund assumption, right?
Yeah, helped by an assumed $400 million tax refund.
Okay, so the near-term guidance seems solid, leaning positive. But how do we bridge from today to that longer-term vision?
That's the key question. They did provide some crucial long-term revenue visibility. They explicitly tied the PCF contracts and this new digital platform together. They're projecting that the combined incremental annual revenue run rate, expected by the end of 2028, will be between $900 million and $1.1 billion.
Wow. Almost $1 billion in new annual revenue by 2028. For a company still dealing with legacy declines.
It's a huge target. They broke it down a bit too. PCF should bring in $400 to $500 million of that. And the digital layer, NaaS, Edge, security partnerships should contribute the other $500 to $600 million.
Is that $900 million plus target realistic, though? I mean, the execution risk feels high.
That's absolutely the friction point. It needs near flawless execution. It needs continued demand from the hyperscalers. But again, look at how they plan to measure it, that PXQ model. It suggests they believe they've cracked the code on monetizing this AI era differently.
Measuring value creation in a new way, moving the goalposts from traditional telecom.
Exactly.
Okay, this is clearly a multi-year story unfolding. But traders, they live quarter to quarter, right? They need catalysts sooner than 2028.
Absolutely. We flagged about 4 main things that investors and traders are going to be watching really closely in the coming quarters.
What are they?
First, just immediate updates on PCF and NaaS deals, any new AI partnerships announced. The market wants to see that continuous demand flow. Keep the momentum going.
Makes sense.
Second, definitive progress towards that early 2026 AT&T deal close. Milestones, updates. That is the single most critical deleveraging event. It's the key to unlocking potential multiple expansion.
So deal progress is paramount. Third,
they simply have to deliver against that bullish FY25 guidance when they report Q4. Any kind of slip up there will inject massive doubt back into the story.
got it. Execute on the near-term promises. And finally,
The initial look at the FY26 financial framework. We'll probably hear more about that at their next Investor Day. That gives the first glimpse of the financial profile after the big debt restructure.
okay, so those are the catalysts, and this mix of debt de-risking plus this long-term growth visibility,
Yeah.
it's created some pretty wild volatility.
Oh, yeah, truly elevated volatility, which, naturally.
Which leads us right into our segment designed purely to spark some thinking about market views and possibilities.
Okay, this is Talk Tickers, and just to be absolutely clear, what follows is purely for intellectual discussion. It should not be taken as financial advice in any way, shape, or form.
But we have to talk about the situation here. You've got 30-day implied volatility sitting way up there, around 128%.
Yeah, and the stock itself has had a massive run, up nearly 70% in just the last month.
So the value proposition feels almost binary now, doesn't it?
Sure.
It really hinges on that structural change from cleaning up the debt.
Completely. And arguably, the market might still be underpricing the certainty of that early 2026 AT&T deal closing and the full impact of that $535 million annual interest saving.
So the high short-term volatility, maybe it creates an opportunity.
A fascinating one, perhaps, to finance a leveraged longer-term view. The core thesis is pretty simple. The stock's valuation multiple should expand significantly once that leverage drops below 4x adjusted EBITDA.
And that structural shift feels almost inevitable if the AT&T deal closes as planned.
Right. So, okay, here's the outrageous but plausible trade idea to kick around.
Let's hear it.
A highly leveraged, long-dated option strategy, focusing entirely on that debt resolution catalyst. It's a 2-part play.
Okay, pardon.
First, you'd look at selling a new term out-of-the-money put spread. Why? To collect premium.
Capitalizing on that super high short-term IV the market's pricing in right now.
Yeah.
Generating some income like selling insurance.
Exactly. Then, part 2, you take that premium you collected and use it to buy a long-dated, deep out-of-the-money call option, specifically one expiring maybe mid-2026.
Targeting the time frame right after the AT&T deal is expected to close.
Precisely. The idea is to lock in a potentially low entry point before the full impact of that $535 million interest saving hits the books, before the balance sheet is officially de-risked in everyone's eyes.
So it's a high-stakes bet, leveraged, focusing on the structural debt fix rather than getting chopped around by the quarterly earnings noise.
Yeah, you're essentially using the market's fear of short-term volatility to finance a strategic bet on that longer-term value unlock from the deleveraging.
Interesting angle. Okay, so let's recap our deep dive into Lumen's Q3.
What we saw was, a small financial beat, but that was almost overshadowed by the massive progress on the balance sheet.
And the digital platform NaaS and PCF, it's clearly evolving fast. It's gaining traction. It provides a credible path, though definitely a challenging one, towards that goal of over $900 million in new annual revenue by 2028.
The core finding really is that Lumen is hitting the reset button. structurally resetting its identity and its balance sheet at the same time. Management is being really aggressive, basically saying their new network architecture is fundamental for Cloud 2.0, for the whole AI build-out.
They believe they own that essential physical layer that everyone else needs to plug into.
Right.
Which raises a final provocative thought for you, the listener, to mull over. If Lumen is fundamentally changing how telecom works to support AI, and if their physical assets are so crucial for hyperscalers, how quickly will the legacy competitors be forced to ditch their old models and follow Lumen's lead? Or is Lumen actually building an unmatchable lead here, both physically and digitally, that could define the next decade of infrastructure?
Something to think about. And remember, we are talk tickers. This has not been financial advice. Past performance doesn't guarantee future results, and options trading carries substantial risk. Always do your own research.
Absolutely. That's it for this deep dive. We'll catch you next time.